For this presentation, we are going to cover research and development costs and how they were treated under GAAP versus the international standard. We'll show the journal entries for GAAP versus the international standard and the working paper adjustments. So here are the guidelines. Under GAAP, research and development costs must be expensed in the year incurred except for those costs associated with development of computer software when specific criteria are met. Under the international standard, all research costs are expensed immediately, but development costs can be capitalized if they meet the criteria of IAS 38. And then an intangible asset can be created and amortized over the service life once the product is brought to market, but it cannot exceed 20 years for amortization. So again, you cannot start amortizing until the product has been brought to market. Now let's take a look at an example. Mike incurred research and development costs of $500,000 in 2017, of which 40% met the criteria under the International Accounting Standard 38, indicating that an intangible asset has been created. The new product was brought to market in 2018 and is expected to generate revenues over the next 5 years. Mike needs to prepare financials under the international standard, ignoring taxes. So what we're going to do is first look at the journal entries under GAAP and the international standard for 2017 and 2018, and then what are the entries for the conversion worksheet when you go from GAAP to the international standard for those years. For 2017, the entries would be different because GAAP would expense all the costs versus the international standard, which would allow the capitalization of the $200,000 as an intangible asset. So this would be our journal entries for 27 under GAAP. The whole amount would be expensed, and for the international standard, only $300,000 would be expensed, and the other $200,000 that has been identified as an intangible asset would be capitalized. But we cannot take any amortization because the product has not gone to market yet. In 2018, the product does go to market. There would be no journal entry for GAAP since we've already expensed it all in the previous year, but for the international standard, we would get to amortize $40,000 by taking the $200,000 divided by 5 years. So no journal under GAAP, but under the international standard, we would amortize the $40,000 and take it against the deferred asset. Now, what happens on our conversion work papers? In 2017, for the conversion work papers, going from GAAP to the international standard, we are required to reduce our R&D expense by $200,000 and treating it as an intangible asset. We do not do any amortization. In 2018, again, we need to set up the intangible asset and reduce expense in the prior year by $200,000 by crediting retained earnings. Then we need to start recording amortization because the product has been brought to market. Again, here are the working paper entries. For 2017, what we would have done is set up the intangible asset and reduced expenses going to the international standard. And for 2018, again, we would set up our intangible asset, but this time the adjustment would go to retained earnings because it was expensed in the prior year. And then we would do our actual amortization since the product has gone to market, and we would book the $40,000 and reduce our intangible asset by that amount. So a summary of these changes and how they affect the income statement and the balance sheet. On the expense side, on the income statement in 2017, we would have booked R&D expense under GAAP of $500,000 and under the international standard only $300,000, which means we have a difference of $200,000 we have to account for on the working papers. In 2018, we would have to adjust by $40,000 for amortization because we would be booking that under the international standard, but we would not be under GAAP. Now, what about the balance sheet? On the balance sheet, under GAAP, we'd have absolutely nothing for both years. Under the international standard, we'd have our deferred R&D at the end of the first year because it didn't go to market of $200,000. Then we'd have our amortization, and then we'd have a net book value of $160,000 under the international standard. That includes what happens when we have R&D costs under GAAP versus IGAP.